Hey everyone, good morning. Today is Monday, December 4th, a bit past 9 a.m. Pacific time, and I want to go over a trade that I did in SPX this morning, and it was the popular variety trade, 0 DTE. I've been looking into these short-term trades is related to the 0 DTE, 1 DTE, in that ballpark. But anyway, this morning I was feeling a little bit stressed out, and I felt it was a particularly good time to go get some exercise. But I didn't want to go without having something on in the SPX. So what I did early was, let me pull up today's fills, and particularly, let me focus on SPX. All right, so we'll see that at 7:42 a.m., I bought a call spread. The strikes at 45.60 and 45.65 is where I sold a call. So it's a bullish call vertical, and let's take a look to see where SPX was trading at that time. So that was marked 7:42 a.m. Here's a 1-minute chart. So roughly around here, let me go over a bit. These bars represent 1 minute in time, by the way, on this chart. So let's see. It looks like it was trading at roughly 45, 46, 33. Bouncing around, it was making a bit of a ledge here at 7:28 a.m. in the, let's see, 40, yeah, in the 49, around the 45.50 area. We'll notice that there wasn't a lot of range, but it was hanging around this 45.50 area. And a minute or so before I executed, it was just basically sitting there in the same area, 45.50, 45.50, 45.50. I did mention 45.46, but at 7:42, there was basically a one-handle, not even a one-handle range, no movement here. It was sitting at 45.50. So as a short-term trade, this area that I'm highlighting here with the mouse became somewhat interesting to me because I thought it was forming a bit of a ledge and it could go higher from here. There's a lot of interest in the 4600 area, which we were at last week. We were very close, and then we came off this morning. So this particular setup was of interest to me as a short-term long trade. After I executed, the market did go down a little bit. We got down as low as 45, 46-ish. Yeah, just under 45, 47. But anyway, I was looking for a bit of a bounce, so I bought a call vertical spread, a little bit of a bullish play. Now, I got out of it in a particular way. Let me go back to the activity tab. I exited this trade by buying a put spread. And what I did here was I bought the 45.65 put and I sold the 45.60 put. Now, one reason in particular why I did that, I could have exited this trade by simply, and I'm talking about the call spread here, the 45.60, 65. I could have exited this trade by doing the reverse, selling the 60 and buying the 65. So what that would look like, let me go to an area where I don't have market on. So I was long this, and I could have exited by doing the opposite, selling the 60 and buying the 65. All right. But a problem with doing that for a lot of people is that they might have pattern day trade issues. So you get 3 of those, I believe, within a 5-day period. And you don't want to run into that type of problem. So how can you avoid exiting this type of trade in particular? All right. There are several ways you can go about it. I guess I'll go over 2 of them. And one of them is what I decided to do. So let's say that you want to exit this trade, but you don't want to step on the strikes you already have. So you could simply sell one of those, sell another one of those, the 65s, and you could buy a 45.70, and that would leave you with a butterfly. And I'll show you what that looks like. And if you get the right prices on those, then you basically lock in a profit, and you don't have to worry about it. This is showing a lot of red here because of the prices I'm using for this example. I'm not going to be able to lock in a profit with these prices. Another way you could exit this trade is you could sell a call spread a little bit higher, and that would basically give you a condor. So let me widen this out by a few more strikes so we can see this a little more clearly. And that will give you a condor. And if you get the right price on your entry and your exit, then you're going to have green everywhere in this trade. Okay, so what I actually did here was, if you remember in the call put parity videos that I've put out before, there are several of them. I advise you to take a peek if you don't remember them or if you haven't seen them. What I want to get at here is that a call spread is the same as a put spread. So I can exit this trade without creating any pattern day trade issues by simply buying a put spread, which is what I did. And I bought the same strikes. I bought a 45.65 and I sold a 45.60 on the put spread. Now, why is this the same? Because let me isolate the puts here. If you are buying this put spread, okay, this makes money if the market goes down. So let me show you what that looks like. You have debit risk here, which is the cost of the trade, and that's going to be your max loss, whatever you pay for it. And your max win is going to be the difference in the strikes, which is 5 handles minus the cost of the trade. So here, that would be $275 if we paid $225. The max profit is $225, and you see that up here. So should the market go down past your strikes, that's going to be your max profit. And if it closes within your strikes, you're going to have the intrinsic value. But anyway, what I'm saying is this put spread is the exact same thing as selling a call spread at those strikes. So let me go back to the table and I'll show you what I mean. So let's say you sold the call spread at the same strikes. So you're going to sell the 45.60 call. You're going to buy the 45.65 call. And remember what I showed you a minute ago on the analysis tab. And if we go back and look at this short call spread, we will see that it is exactly the same thing as the put spread. Your profit's going to be exactly the same should the market go down. Your loss is going to be whatever you ended up, your max loss here is going to be the difference in the strikes minus yada, yada, yada. So here we're going, max profit is 270 and the max loss is 230, 225, which is going to be what you paid when you bought the put spread. But here you're selling the call spread, okay? Notice the difference in the strikes. Notice the credit that you get. So let's say we sold it at 270 and the market rallies, okay? Your max loss there is going to be 230 because you're going to lose the value, any value that you have in these options, and that's going to be a total of $500 here on this spread. All right, work through it so that you understand clearly what I'm talking about. However, you got a 270 credit, so that defrays the max loss of $500. Anyway, we go back to the table here. We will see that once I get out of this trade, my long call spread by buying a put spread, all right? Now what happens when I have this on? And remember that I paid $1.20 for this call spread, okay? So I paid $1.20 for this call spread, and I paid $2.80 for this put spread, which I had in. I placed that order as I left to go work out because I wanted to have something on short term while I was gone. So notice I got filled here at 850, and what I did was I bought the 465 put and I sold the 4565 put, and I sold the 4565 put is the one I bought, pardon me, and the 4560 put is the one I sold. This cost me 280. The call spread I bought cost me 120. So let's go back and look at what happens here. Let's say the market closes at 45.50 or lower. What happens here? All right. The put spread is going to go out for max value at $5, and this call spread is going to be worthless. So this is going to go out at $5, and I paid $4 for it, which leaves me with a profit of $100 on this one lot for each side of the trade. Let's say that the market rallies and it continues to rally as it has, and it closes at whatever, 45.70 or above, anywhere above these strikes that I'm involved in. Okay? Well, in that case, the put spread goes out worthless. I lose what that cost me. The call spread will go out at max value, which is $500, but it wasn't free. I had to pay for it, and I paid $120. I also spent $280 on this put spread. So I spent a total of $400. But no matter where this goes out, above or below these strikes, one of these spreads is going to be worth $500, and I paid $400 for it. What if it closes in between these strikes? Well, then there's going to be intrinsic value for both of them, and that intrinsic value will add up to $500, and still I paid $400. So what does this look like given the price that I paid for each spread and where the spreads are going to close out at expiration? Well, my situation is going to look like this. All right. So no matter what happens here, I make $100 on. Let me show you. Actually, this has my. This is the example trade. So let me go to my positions tab here, and we will highlight that. Now, this will show what I'm talking about. All right. So as you can see, at expiration, no matter what happens at this point, this trade has the 100 locked in because, as I mentioned, I paid a total of $400 for the spreads, and if the market closes anywhere below, one of them is going to be worth $500, the other is going to be worth $0. If it closes anywhere above this area where I have options on, it's going to close at $500, and I paid $400. So I'm still going to make $100, and anywhere in between, each of them is going to have intrinsic value. And because I went to the put side to get out of this call spread, I don't have to worry about a day trade issue. So I believe for the pattern day trader rule, you have to have at least $25,000 in your account. And I realize that not a lot of people have $25,000 in the account. So exiting this type of trade can be a problem if you're stepping on strikes when you do that. And I didn't want to do that. And I wanted to show an example of how to avoid that problem or that potential problem should you have PDT concern because of the size of your account. So anyway, the takeaway is how to get out of trades and reasons to get in trades. There are a bazillion of those. So let the buyer beware. But as far as getting out of trades, there are also ways that you can get out of trades and not concern yourself or be concerned with a pattern day trade issue. Okay, I hope that was helpful, guys. I will catch you next time.